Ladies and gentlemen, good day and welcome to Q1 FY23 earnings conference call of Securekloud Technologies Limited, hosted by Kirin Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vastupal Shah from Kirin Advisors. Over to you, sir.
Thank you. Good afternoon, everyone. Thank you for joining the conference call of Securekloud Technologies Limited. I would like to welcome Mr. Ravichandran S., Full-Time Director of the company, and Mr. Tyagarajan R., Full-Time Director and Chief Financial Officer of the company. Tyagarajan sir, over to you.
Hey, thank you, Vastupal. Good afternoon, friends. Thank you all for joining the earnings call for Q1 financial year 23. Today, unfortunately, Mr. Suresh Venkatachari is not able to join us due to medical reasons. We are happy to announce that Healthcare Triangle, our step-down subsidiary, raised $6.5 million from a private placement with one of the largest healthcare funds in the US. The year has begun excellently well for us. From a revenue standpoint, we grew 3.6% sequentially and 22% year-on-year. Our services are continued to be differentiated with digital and cloud value proposition for our clients. Growth across the quarter has been broad-based, across all our business segments. Revenues for the quarter came in at 110 crores. This compared to 90 crores in Q1 FY22. Healthcare revenues increased 16 crores or 25%, came in at 80 crores for FY23 Q1. And ICT revenues grew 4 crores. ICT came in at 30 crores for the quarter as compared to 26 crores. One of the key metrics that we measure every quarter is the recurring revenues. Recurring revenues for the quarter came in at 42.4%. There has been a steady growth in the recurring revenues through increase in our platform and managed services revenues, which clearly demonstrate a consistent progress towards our long-term operating margins, long-term operating model, and improving the margins over time. Gross margins came in at 22.5% in Q1 compared to 22.2% in Q4. We expect the margins to improve as we acquire more customers on platforms and managed services. As spoken in the last quarter, we have taken several initiatives to improve the delivery efficiency and increase in offshore support, through automation, and through pre-build management. So our OPEX for the quarter came in at 124.5 crores compared to 127 in Q4, a reduction of about 2.5 crores. This was largely due to a reduction in R&D spends. I think one of the stated objectives in the previous calls is, we have peaked on our R&D investments on platforms. So going forward, our R&D cost will go down both in dollar value as well as in percentage terms. We continue to look for cost efficiencies, much more aggressively. We are working on improving utilization, work on rationalizing some of the subcontractors' costs, etc., and importantly, eliminate inefficiencies in the cost model. During the quarter, we reached a promoter loan of 9.4 crores. Our overall debt position as of June 30 stands at 102 crores. On that note, let me invite Ravi to go over the various aspects of our financial performance for the quarter.
And thank you, Tyag, and good afternoon, ladies and gentlemen. And thank you all for joining the Q1 earnings call. It's been a satisfying quarter from a revenue growth perspective. Our demand is continuing to look good, and positioning of our capabilities is resonating well with our clients in the digital transformation space. Clients are seeing benefits implementing public cloud transformation across their infrastructure in many of the large deals that we are working. And we want to make sure that we can optimize the technology landscape that gives them a cost benefit. I would like to share highlights of key wins during this quarter. I'm very pleased to say that we won 7 new deals across all of our business, out of which 6 were new logos, 4 new logos from healthcare and life sciences, and 2 from ICT business. We signed a deal for cloud migration managed services with a leading American telecommunication company, which is one of the significant deals that we are pleased to announce. The other new customers that we acquired in healthcare and life sciences are into healthcare device manufacturing and drug discovery. The previous calls we had mentioned about our investment in R&D to strengthen and enhance our platform offering to engage more closely with our existing customers and increase our market share. We're pleased to announce that we had launched 3 innovative platform-based services, Cloud Edge, Data Edge, and Neutral Zone during the current quarter. And I also signed our first Cloud Edge customer deal with a social impact platform company. So this clearly demonstrates our commitment in terms of the R&D that we had put together for these platforms, a clear indication that the traction in the market is obviously, wanting to have platforms like this. Cloud Edge is a fully managed and highly automated cloud foundation platform that facilitates enterprise to transform and manage their cloud infrastructure across any public cloud service provider. We believe that our highly secure, fully automated API-driven platform will continue to remain a key differentiator and help us grow business across multiple geographies. With that, I would like to open the forum for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have a question from the line of Aniket Dogra from Centrum Broking. Please go ahead.
Good afternoon, gentlemen. I have a question for Mr. Tyag. I have a few questions for Mr. Tyagarajan. Can I start?
Yes, Aniket, go ahead.
Mr. Tyagarajan, good afternoon. On the presentation, if we can go to slide number 6, page number 6 on the presentation. So, can you explain me the cost structure? It says cost of sales of around 85.5 crores and selling and general administration expenses at 33 crores. On the exchange website, the cost structure is not as detailed. It just gives salary cost, employee cost, other expenses, and financial other costs. So I just want to understand the employee cost of 99 crores as to how it is bifurcated in this slide on page number 6.
Okay, so thanks, Aniket. Let me answer the first question. See, the employee cost for the quarter was 100 crores, which is what we reported in the financial statements for Q1. The 100 crores, if you look at it, there are people who are delivery guys, there are people who are, people who work on R&D projects, and people who are on SG&A like me, Ravi, etc. Right? So, they are split between, in the presentation in the income statement that you're referring to, the 85 crores has people who are directly working in projects, right? That cost will be there. So there are two elements of cost in that. One is the direct project-related labor cost, and there could also be project-related expense like travel, some, cloud hosting cost, etc., etc. So some of the cost may be part of that, right? Okay. Second is the R&D cost, which is again got labor and cloud hosting charges, what we call as other expenses, right? And SG&A has got all the people-related cost, the marketing expenses, the commission for the sales guys, the audit-related fees, the admin fees, rent, power, etc., etc. So, the overall cost structure for the company is, if I look at it, 100 crores of employee-related cost and 25 crores of other expenses, which is split between these two lines.
Okay. So in the income statement on the exchange website, so that 100 crore is the total employee cost, which can include some component of bonuses and some employee costs regarding selling and general administration expense and other R&D, all those costs included, right?
Absolutely right. The 100 crores in the exchange website, the financials, denotes the cost as per the on the total overall cost, whereas the presentation reflects the cost based on the nature of work the people do. So somebody who's working on R&D projects, we have classified as R&D. Company folks working on direct projects will be part of the cost of sales.
Okay, understood. Also, Mr. Tyagarajan, so now on the presentation, when we see that around 42.5% of our total revenue is coming as recurring expense, which is slowly and steadily going up, why isn't the cost not reducing? So if you have 100 crores, 110 crore of revenue for the quarter and 42 is the recurring cost. So last 5 quarters, if you see last 4 quarters and this being the 5th quarter, your cost of sales or employee cost is around 95% of total sales. So even though we are gradually increasing from 35% to 42.5% now, so why isn't the cost not coming down?
Okay, so good question. So 2 things, right? Our cost, if you look at it, one of the objectives that we've clearly articulated in many calls, Aniket, is reduction on spend. We have front-loaded some of the, platform-related cost. Ravi just, briefly mentioned about some of the platforms that went live, right? So most of the costs, if you look at it, for instance, we used to run at a quarterly run rate of 10 to 12 crores on R&D, right? So a couple of quarters back, it was 9.5 crores. So it's come down to about 6 crores. As we keep adding more and more customers through the platform, the cost to deliver will come down. So that's how the margin improvement is happening. But since, most of the costs are front-loaded, you will have to believe that these costs are all peaked out. So, we've mentioned it in the past as well, that all the platform-related costs, all the, sales and marketing-related costs have all peaked out. So, going forward, most of the revenue that you will get, the gross margins will flow into PBT because all our costs are all fixed in nature, right? So, the incremental delivery cost is going to be there, but whatever margins we get, gross margins will all flow into PBT, Aniket. So one of the things that we also do is, we keep acquiring customers on long-term projects because, cost of sales we don't have a cost of selling to the client in years 2 and 3, right? Commission is paid only upfront in year 1. So, that way the, incremental revenues from the customers go directly into margins, right? That's one of the objectives. And second most important thing is that, as you speak, most of the delivery, we also said that, right? So because of COVID and other restrictions, a lot of the delivery was on-site and, we had to rely on expensive 1099 contractors in US. And most, as you know, 95% of the revenues come from US, right? So where, because of all the travel restrictions and other things, cost delivery went up significantly. But, we are rationalizing through building more R&D in India through, a mix of offshoring and getting more interns and trainees into the projects and grooming them for, bigger responsibilities as we get along. I think, 2 key things. One, as we keep looking for, efficiencies, one of the things that we are already doing it is, moving R&D to India. So that will start reflecting in the R&D cost going down every quarter from now. And second thing is that, enabling a lot of delivery from India so that, managed support and all that from India so that, the margins go up over time, Aniket.
So, Mr. Tyagarajan, so if I come back to the slide number 6 again of what you said in terms of efficiency of bringing the cost down from on-site to offshore and on India platform in India, so cost will come down significantly. So which of the cost will come down? See, R&D expense is only 6 crores, So you mean to say that cost of sales from 85 crores, that portion will come down significantly over coming quarters? You mean to say, or the 6 crores will come down further? Or SG&A, I presume that it is going to remain the same because it is not a variable component. So what can come down? I'm just trying to understand. Like, for example, if we go to a revenue run rate of maybe 150 crore also in coming quarters, the sales, I just want to understand, will the cost of employees go again up to 120, 130 crores, or it will remain at 99 crore or in fact come down more?
Okay, good question. So let me break your question into 2 parts. So first part is the cost that will go down as we keep offshoring is cost of sales, right? Because we start delivering some projects from India. So the 85 crores on absolute terms, dollar terms will go down, right? Second is R&D. So currently we spent about 6 crores. R&D has got 2 components. As I said, one is a labor-related cost, second is an expense-related cost. So the labor-related cost will go down, expense will still, because we have to host the platforms and test it, so that will yet be there. But the labor-related cost will go down. So the mix of, labor to expense is about 80 to 20, right? 80 is the labor and 20 is the expense. So we will yet have the 20, but the 80% of the cost will go down over time. That's point number 2. Point number 3 is SG&A also has some costs that are, for instance, marketing related costs, where we front-loaded the cost, so there will be some efficiency from there. See, to answer your point on the second question on, what if revenue goes to 150 crores, the costs will not go proportionate to, the revenue or the same ratio. For instance, let's say 40 crores of revenue comes, 20% of that comes on platform. For me, delivering platforms, the incremental cost is very minimal, right? So let's say 20% is only my incremental cost of delivering platforms. The 80% will come to gross profit, right? So, what we can tell you from a rough thumb rule perspective, on a $100 extra revenue, my gross margins can be in the range of 35 to 40%, where SG&A will be flat or marginal.
Okay. Just a follow-up question on that. Now, out of the total 100 crore as employee cost, how much is US and how much is India? India will be very insignificant, right?
India will be about 10 to 11 crores. I think it is there. 11 crores is India cost, and 88 crores is US cost allocated. So
okay.
Look at the standalone.
Some part can shift to India and okay.
Yeah.
Okay, understood. Okay. Can I ask a question to Mr. Suresh, or should I come in the line again?
Okay, so Suresh is not in the call. You can maybe, just wait for a few minutes. If there are other callers, you can just come back in the queue.
All right.
Thank you. We have our next question from the line of Harish Barai from Larsen & Toubro Limited. Please go ahead.
Hi, Tyaga. How are you doing?
Hey, Harish. Good afternoon. How is it going?
Great. Tyaga, I just wanted to understand, see, on a quarterly basis, we keep posting about 10-15 crores of PAT losses. By when do you think the company will get into a profitability mode and start generating cash? Because there is a limit up to which the cash can be burnt. At the rate at which we are continuing, I don't think we can survive long enough. So, would you want to add some color on that?
Okay, so our cash burn for the last quarter was about 13 crores, Harish. So that came down from 21. We reduced the cash burn about 7-8 crores in the last quarter, right? We are confident we'll reduce another 7-8 crores this quarter, right? It's an extension of Aniket's question that at what point in time we'll turn profitable. See, if you look at the P&L, our P&L is very straightforward. So currently our gross margin is the ratio of 22%, right? So we believe that as we keep adding more and more managers and platforms which have a higher share of revenue margins, we will get, even if it's 4-5 basis points increase in the margins, that will flow directly into EBITDA. So at what point will you break even? 130 to 135 crores is when we will break even.
So, which can happen in the current year, or is it something that will not happen?
As we speak, we have visibility up to Q4. We will, perhaps, let's not be a forward-looking statement, but I think in Q4 we'll be close to breaking even.
And what is the visibility on growth? Like you last quarter had given the order book details, but we don't find it this time in the presentation. So, is the business flowing in, or is it stagnated for some reason?
So we've not seen any stagnation in orders, Harish. So as we speak today, we have clear visibility. For instance, our run rate at 110 crores is 450 crores. So at the beginning of the year, we had given a guidance of 20% top line. We are there, 18-20% top line is what we had given. So as we speak, we will get to that run rate of 115-120 crores as we move to the year, right, from an average perspective. So I think we are there from a revenue standpoint. And as of now, we have clear to nearly 90% of the revenues for the year, right? That's already in the bag. So, the focus is to, get a mix of revenues which gives us higher margins, more, recurring and platform customers on SaaS, so that, it not only improves the margin, it also kind of makes the revenue far more predictable, Harish.
Yeah, and just one last question. This healthcare triangle dilution that happened at $1. We thought it was a bit of a surprise, because just some time back there was an announcement that there will be some share buyback, and then we have a issuance that was announced at $1. So it was all confusing, Which way are we heading? We did the IPO at $4, and then
now a dilution at $1. So ultimately, it leads to dilution for the parent shareholders, right? So we just wanted to have a better understanding around that.
I think you are right. So initially we did the IPO at $4. Then we announced a buyback. So I think the intrinsic value is not 60 cents or 65 cents in the US. So it's much higher. So which is why we announced the buyback. And then immediately we got a prestigious fund to invest in the company. So they came in, and one of the largest healthcare funds in the US. So they came in and picked up a sizable chunk of equity in the company in healthcare triangle. Why? Given the situation in US, right, with stress on raising capital, we thought it is better to raise capital at this point in time, given that we need money for growth. But more importantly, as I said, right, we will the next couple of quarters, maybe 2-3 quarters, we will start throwing cash into the balance sheet. So that's mainly to survive the next 8-9 months for growth, and then the business starts throwing cash back into the balance sheet. Harish.
Thanks a lot, and wish you good luck, Tyaga.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question from the line of Sandeep Mane, an individual investor. Please go ahead.
Hello.
Yes, Mr. Sandeep, go ahead.
Yeah, good afternoon, sir.
Afternoon.
I have a few questions. What will be the debt structure going forward?
Go ahead, sir.
Hello.
Yeah, go ahead. You said you had three questions.
What will be the debt structure going forward?
You mentioned debt, right?
Yes.
Okay, so we reported a debt of 100 crores net debt in June. Subsequent to that, we raised capital approximately 50 crores. So currently, our gross debt is about 110 crores and cash of about 60 crores. So net debt of 50 crores, right? So we are from a company standpoint, we are burning around 12 to 15 crores of cash every quarter. So if you take the cash out, so 25 crores. So net debt by end of the year will be around 75 to 80 crores, assuming all things remaining constant, Sandeep.
Okay, one more question, sir. What was the impact of dollar price on business? Sorry, what was the impact of high dollar price on business?
Okay, so we did have some, I think the average rate for the quarter was around 79, so we had some benefit from our cost, right?
Okay.
But we don't measure it that way because we are dollar accretive in nature, because all the costs are in INR and we earn in dollars. So dollar depreciating is actually beneficial for us. We've accounted at 79, but we don't have a view on where the dollar is headed because foreign exchange is not something that we track.
So, thank you.
Thank you. Participants are requested to press star and 1 to ask a question. We have our next question from the line of Apurva Mehta, an individual investor. Please go ahead. Mr. Apurva Mehta, please check if your line is muted. Since there is no response, we'll move on to the next question from Aniket Dogra from Centrum Broking. Please go ahead.
Hello. Hi. Hello, Mr. Tyagarajan. So instead of asking Mr. Suresh, can I ask you the questions which I had?
Yeah. Yes, sir.
Okay. So, Mr. Suresh, when Mr. Harish mentioned about dilution of shares, so I'm really absolutely, absolutely stunned as to why the management, despite having so much experience and so much business acumen and so much solid experience, why have we not able to gauge what is our planning? Because we reduce the issue size, thinking that we don't need so much capital for near term, and within 6 months of coming out with IPO, we not even 8 months of coming out with IPO, we did a dilution, and that too at such a low rate. So actually it raises quite a lot of questions on the mind of investors as to is the management aware as to where they are headed and what is the strategy going forward, and why are they able to have some business business vision as to where they are headed. So raises a lot of questions. So if you like to comment on that.
Okay, so let me address the second point. I think from a business standpoint, the management is clear in terms of where we are headed. I think we've mentioned it many times in the past. We want to be a health, platform-focused managed services company, right, with significant focus on growing our annuity revenues, right? That's something that we've stated. But you look at what happened in October. I think we can't control the external geopolitical events that happened, Aniket. So Nasdaq peaked out. Almost all technology stocks peaked out in September, and crashed inexplicably in the next 3 to 4 months. We followed up with a Ukraine-Russia war, which was unexpected, and then oil embargo and all that, right? So I think a lot of this has got to do with the geopolitical issues, which is completely out of our control. From a business standpoint, if you look at it, we've kind of grown. Yes, we clearly stated that one of our objectives is to keep investing in R&D and sales and marketing. We got the people on board. We are actively engaged in conversation with clients, and many of these conversations are on our platforms as a go-to-market, right? So from that standpoint, I think management is very clear where we are headed. But these are geopolitical issues which nobody has got control over, right? And given that we don't know how long these issues will last, we had to go and raise the capital because it was available, and we kind of mobilized the capital. We don't know what will happen tomorrow. So given the issues that market is facing today, we raised the capital. But yes, we are aware that there was a dilution, but this is something that we couldn't have avoided. But this capital is more than anything. This capital is required for growth, and that's where we are heading, Aniket.
So why did we why did we not take excess capital at $4 and why dilute it now? Why didn't the large hedge fund which came in, why didn't we buy from the market, and why do a dilution? That's what is a little difficult to understand. So he bought above the market rate. The fund bought above the market rate. He could have easily bought it at market rate when there are so many sellers at 65 cents.
So the buyback is actually happening at market rate only, Aniket. So the buyback, if you look at, we go to announce it to ICT. We had the board meeting on Friday, the ICT board meeting. You will see it in the S1 this evening, right? So we clearly articulated what price we are buying, because the stock price is at a price which doesn't reflect the value of the company. So it is the case with most platform and technology companies. It is not just us. So all some of the names from India, them, right? They've all fallen 80% just like us, right? So see, valuation is something that we don't control. We definitely see a value in a stock which is much higher than that. So we announced the buyback, and we are consciously buying. And given there are restrictions on, we can't just go and buy. We can't create the market to buy, because we've got to be careful about the volumes that get traded every day. So we are given all the restrictions on how do we trade the stock. We are doing it, and we are doing what is right for the shareholders to make sure that the intrinsic value is reflected in the share price appropriately.
So I hope when the new institution shareholder has come in Healthcare Triangle, the money that has come in the company after issuing shares, so is that money used for buyback or
So that money is not used for buyback. We are generating cash from operations in the US company that is being used for buyback.
Okay. So also when you mentioned about new people coming on board, there are others leaving also. So your chief revenue officer has left just after 6 months. So what was the reason for him to leave so early, and what was the reason to hire him at the first place? If if people are leaving at 6 months, these large key people are leaving so early, and are there any large profile exits planned in future, or that signifies a lot of concerns regarding how it is going to be in future?
Okay, so on the specific point of the chief revenue officer, I think people have their own choice, career choices they make. So we should not be able to comment on that. There are no large profile exits from a sales or delivery standpoint, and more importantly, we are a performance driven company, Aniket. So if people don't perform, they are free to choose. In US, how it works, right? If a sales guy doesn't perform for 2 quarters, 3rd quarter's out, right? So that's a culture that every company follows, and we want to clearly articulate that we keep articulating that to our employees, right? So performance based. So we can't. So the market is hot, that, right? So we can't stop people from leaving. But one thing is sure, from an organization standpoint, we inculcate a culture that people perform and people bear the fruits of performance.
Yes, but then we may have done some due diligence also as to why we are taking that person, right? So, we just can't take anybody randomly also. So there has to be some checks and balances for the people, because 6 months salary at such high cost, is gone and without much output also. So in future,
100% right. So, that's why we say it is a performance-related issue, and again, to keep it simple, right? So the guy came with a very decent experience, like healthcare accounts in the US, right? One of the largest accounts in the US, but he couldn't fit into the organization culture. He had a performance-related issue, and we had to, looking at the larger organization, we had to, disengage with the guy in 7 months' time.
So is there kind of a non-compete clause? Because what if he takes because he knows now all the clients of the company and all the, so
we have a non-compete clause with all the senior folks, right? For 1 year they can't, after leaving the 1 year they can't compete and go to competition.
What is the status of the promoter loan at present? 31 crore is Mr. Ramani loan now pending, and how much is out of that? How much is Mr. Suresh loan in the company?
No, there is no Suresh's loan in the company. So the Suresh has to subscribe for 12 crores worth of equity. Ramani's loan is around 31 crores, which is pending, which is what you see in the 30th June balance sheet.
Okay, so
or in the net debt mention, we would have reflected it in the net debt data. 31 crores is promoter's loan, that is Ramani's loan.
Okay, so just one more last question on the status of the case in the Supreme Court regarding the Kumar stock broking and others. So any update on that, or is that long water under the bridge? And
there's no update because there was a hearing that had to happen just before COVID, and because of COVID and all that, this has taken a backseat. This is not water under the bridge. The case is on. That the quantum license was revoked. And we've also stated that these guys were jailed and they put in the prison in Chennai, right? But subsequent to that, they came out on bail, and due to COVID, and most of these cases have taken a backseat. We will pursue it at the appropriate time, Aniket.
Okay. Thank you, Mr. Tyagarajan. If I have something more, I'll come in the line.
Thank you, Aniket.
Thank you. A reminder to participants to press star and 1 to ask a question. We have a next question from the line of Supriya, an individual investor. Please go ahead.
Good afternoon, sir, and congratulations for a very good set of numbers. Hello.
Yes, madam, go ahead. Supriya.
Yeah. So what is an outlook you wanted to share for the current year, as the numbers have been first quarter has been so impressive?
See, the outlook, I think we've shared in the last year. We are, gunning for a top line of 18 to 20% growth from last year, in the range of 450 to 460 crores, madam.
Okay, sir. And like the margins continue to be impressive?
Yeah, so I think I mentioned to the previous caller that currently our gross margins are in the early 20s. So we will, as we keep adding more and more managed services and platform, the margins will improve. We expect to improve the margins in the next 3-4 quarters, and tremendously. I think we hit the bottom of the margin, so it's going to improve over the next 3-4 quarters, madam.
Okay, sir. That's what I just wanted to understand outlook going forward. Thank you so much, sir, and all the best for the coming period.
Thank you, madam.
Thank you. We have our next question from the line of Harish Barai from Larsen & Toubro Limited. Please go ahead.
Hey, hi, Tyaga. Just one query I had. What are the implications of the recent show cause notice that has been issued to Suresh, and it has been put on the exchange also on our... so what will be the implication of that on the company?
Okay, so, Harish, the show cause notice is an interim order. It's an interim show cause notice order, right? The company believes that the order is unfair and arbitrary, and, it contains a lot of inaccurate assessments of facts, right? We had a board meeting earlier, so the board has decided to seek legal opinion on this matter, right? We will, if there are any further developments on this case, we will communicate as per the LODR requirements, Harish.
Okay, so will Suresh be able to subscribe to the remaining warrants that are outstanding, or that also gets
We
cancelled?
are seeking legal opinion on that because the order is a bit unclear to us because there are certain things that very clearly it mentions and certain things are unclear. So we are seeking legal opinion. We will definitely come back as soon as possible.
Okay, thanks.
Thank you, Varish.
Thank you. Ladies and gentlemen, to ask a question, please press star and one on your phone now. We have our next question from the line of Apurva Mehta, an individual investor. Please go ahead.
Yeah, hello. I have few questions. My question is, what is the service-wise revenue breakup?
Okay, service-wise revenue breakup is there in the chart, sir. So 72% of the revenues is from healthcare and life science and 28% is from ICT, sir. 80 crores, I think, is healthcare and life science and 30 crores is ICT, sir.
Okay, and what is the vertical-wise revenue?
So that's the vertical, right?
HCL is vertical.
Okay.
Okay,
And
service line is below, right? As we shared in the presentation, sir. If you meant the service line, the market-facing segment revenue is 72% healthcare and life science and 28% ICT, sir. And the line of business or service line is 64 managed services, 64 software services, 28 managed services, and 8% from platform.
okay, and how many employee seats in India and how many in the USA?
Okay, so as of today, we have around 300 employees in US and around 450 employees in India.
Okay, and any impact on high inflation in your key market US, and what is your expectation for current financial year?
Okay, so the inflation is obviously much higher than what everybody anticipated, right? We just gave a wage revision for people in India, so that is all in the P&L, right? The 100 crores that I earlier spoke about also includes 3 months wage revision for folks, right? So which is as per the performance assessment cycle. Beyond that, we don't expect the cost to go up significantly because most of the costs are all bunked into the P&L from an inflation standpoint. We don't expect it to go up significantly, sir.
Okay, yeah. That's it from my side. Thank you.
Thank you. We have our next question from the line of Milan Trivedi, an individual investor. Please go ahead.
Hello, good afternoon, sir.
Good afternoon, sir.
My first question is, want to know the strategy behind the healthcare triangle setup office in the Singapore, because according to me, like one of our objective, we are offshoring the work from US to India, but now once we go to now SCTI office is being set up in Singapore, so that would be another the cost would be high. Basically, my understanding was it would have been set up into India, then we would have made the objective like we want to decrease the cost, and so this is kind of contradicting. We are setting up an office in Singapore, but the major chunk of work we are moving from US to India.
Okay, so sir, just to reiterate, the HCTI's recent announcement on Singapore launch, it is through a partner, it is a sales office, right? We are not going to be adding too much of cost there. From a market standpoint, APAC's healthcare market is about $100 billion. US is $300 billion, sir. APAC is around $100 billion, and it's a very, very mature market. So one of the things that we are doing is, we have stated that geographical expansion is one of our objectives. Right, as you know, we've got 95% of the revenues from US. We think that there is a market for our products and services, and Singapore being one of the core technology markets, we are kind of using one of the large partners there, a partner with solid experience in these markets, the reseller of healthcare services for large pharma companies. Right, so we are using their expertise. So it's going to be a JV, sir. So we don't anticipate too much of cost from this JV. But, we would expect revenues flow once, our services are out in the market. Yeah, and as Ravi articulated, the support cost will be done out of Chennai, so which is much cheaper than doing it out of US, sir. So, while the billing may be lower, as you know, Singapore has got a lower billing than US, but the cost is going to be much lower because we'll be delivering it out of Chennai.
Okay. My next question is about how do we now? It's been more than 6 months for DevCool acquisition. So when we acquired a company, like we saw that DevCool has 20 million revenue. Okay, now it's been 6 months that we acquired a company, but our revenue figures are not that much in line to what we have seen the news earlier. Okay, now we want to know that within the 6 months, how many of the DevCool customers we are moving to our platform-based products.
Okay, so DevCool, as you know, has a run rate of maybe it is there in the thing. So DevCool has a run rate of $5.5 million quarterly. When we acquired them, we were close to about $20 million, little less than $20 million. So they have in 6-8 months they have reported 10% growth in top line. So DevCool is a healthcare model where they work with hospitals across the US on Epic implementation and support. Right, so they are on target to meet their plans for the year. If you look at it, right, so two things. One, DevCool, we have an opportunity to sell some of our, about our platform called Readable.ai. We are already in discussion with many of DevCool's hospital, where we will take Readable to automate some of the process. Readable is a document management platform, right? So currently we've, it is implemented in 2 of our customers, and we are already in discussion with 6 other hospitals in testing that product. So DevCool gives us an opportunity to go and upsell our Readable product. So currently we are in discussion with DevCool's customers as well. But you will slowly start seeing action, from that standpoint that we will have incremental revenues coming from DevCool customers also once we start cross-selling our platforms to DevCool's customer base.
Okay, so as of now, we were not able to move any one of them to platform base, right? We are not able to sell any of our Securekloud or HCTI products to them.
Not as that. Most of the there are discussions that are happening, right? So we've got just to give you a number. So we've got higher share of business from DevCool from a managed support standpoint in the year, right? Which is also a stated objective for us, but platforms not yet, because there are 2 of all our platforms, both CloudEasy, DataEasy, and Readable can be deployed in DevCool. There are testing that's going on. But hopefully we will in the next 6 to 8 months we will start seeing more traction from a revenue standpoint by cross-selling some of our solutions to DevCool customers.
Okay. One more question I have is now Suresh Venkatachari has been money is coming in when he is acquiring the warrants, right? So now how that money is being used? We see the R&D expense, our R&D expense is going down. So basically I was thinking that money may be used to do buyback or it will be used to clear some debt. So just can you throw some light on that?
So you are right. So R&D, we use R&D from our internal generated cash flow, sir. So Suresh's a subscription of warrants. If in the past we've used that money for development work for our platforms, and also use some money for settling some of the retiring some of the loans. Right, that is something that we've already done. So if you recall, Ramani had a loan of 55 crores. We brought it down to about 31 crores in the last 18 months. So our objective is to over the next 2 to 3 quarters retire as much as possible all the debts, and then be debt free. Just have the working capital debt in the books, which is anyway marked against our AR, and all the non-working capital related debt to be retired over time.
Okay, but if you see the presentation, so we have paid some debt, but now we have increased the working capital debt, so the net effect is same. So I don't see
good for the business, because we are increasing this against our AR. So as the AR goes up, we pledge the AR, factor AR and borrow the money. So that's reported as working capital debt, right? But I think more importantly, if you look at it over the last 4 to 6 quarters, the promoter debt would have come down. Even our convertible note that got converted to equity, and promoter debt has come down from 52 crores to about 31 crores now, right? So that's something that we consciously keep retiring as we have cash in the business.
Okay. One more question I have. So this is with respect to on the same line on the forensic audit part. So like 6 months back when I raised the question, we got the answer that the company would make all effort to close it as early as possible, but looks like it is open. So any visibility that how much time it will take to get it to the closure?
Okay, so as I said earlier to one of the previous callers, there is an interim order that has already been passed, and the show cause notice is already there, right? So the company is taking all necessary legal action to bring the issue to an end, sir. So I don't know, I don't have a time limit, but make no mistake, our objective was to come out clean from this issue as soon as possible.
Okay, and one more last question from my side. So Mr. Ravichandran mentioned that we got the first customer for Cloud Edge. So what would be the deal size? Is it a medium-sized customer or just a small customer?
It's a medium-sized customer. At the moment, we just started. So the annuity revenue is still not known at the moment. So we are doing the first initial deployment and transformation. So in the coming quarter, we will have better clarity in terms of what's the deal size, because we are trying to push for a longer duration annuity-based managed services contract with them.
Sure. And the follow-up question on that, so now we are looking for expansion in India. So what is the market size for all of the three products that we have launched in last quarter? So how much is the market size in India, if you can just throw some light on that?
I don't believe that anybody has done any detailed research in terms of the market size in India. But from the queries that we get from India, we see a significant increase in the number of customers, from medium to large enterprises wanting an automated platform for their transformation journey. So we believe that, even if we get a small percentage of that, we believe that, grow significantly in India.
No, not just India. Let me add, I just briefly mentioned, APAC as a market. If you look at it, APAC market has got, this is Gartner data, APAC market is about $100 billion in healthcare spends, right? So that's a big market, and, that gives us the opportunity to go and sell our solutions there. So, we've clearly articulated this in the past as well, that, our plans are, deliver from India and look for adjacencies in the geography, so that, we have the benefit of working from India related time, so people can manage all the 24/7 support. It's easy to attract talent to work 24/7 in this market, and more importantly, cost structure gives us more margins from these deals. So as Ravi rightly mentioned, right now it's the professional service work of implementation that is going on, and once that is done, once the managed service kick in, we can give in more data, but right now we are not able to divulge that at this point.
Yeah. Sure, but see, the Epic, HCTI, basically the product that we launched from Securekloud, I was assuming that would target for the non-healthcare customers, right? So this, what you mentioned is about healthcare customer market size. So I just want to know the product that we launched, right, for the ICT, basically non-healthcare domains, rest all the domains, right? So is there any market size that we have anticipated and then we thought we will target in Indian market?
As I mentioned, right, at the moment, that information that, specific to India for a non-healthcare, I don't think there is any research available to be able to get the data. However, we'll be more than happy to try and dig around to find that market information and circulate it later if that is required. But more importantly, I think what is relevant from a business standpoint is the kind of inquiries that we are getting. And both from, the medium to large enterprises who are seeking services based on platform, that's increasing significantly, which gives us a kind of an idea as to the market size is evolving, and it is going to be significant that we want to play that market. And the one that the Cloud Edge customer is based out of North America, correct? So we believe that that market is even larger than just the healthcare. So yes, the answer to the question is much likely to be larger than the healthcare, domain. At the moment, we do not have information to say how much more it is going to be.
Okay. Thank you. That's all question I have.
Thank you. We have our next question from the line of Krishna, an individual investor. Please go ahead.
Hi, good afternoon. I would like to know where we're going to stand after 2 years, or profit-wise or company growth-wise. I'm seeing last 2 to 3 quarters are always in loss now.
Sorry, sir?
Last 2 to 3 quarters we are seeing in the losses.
Yeah, I think, I did mention that, we have, the losses are mainly because of, investment in some of the R&D related activities. If you look at it from a gross margin standpoint, we've been, we were earlier in that, 27-28%, but because of a mixed impact, because we acquired DevCool, which has got a lot more software services business, the margins came down. So one of the first objectives for us is to get to about 30-35% gross margin, which I think we will get there in the next 5 to 6 quarters. And, we have kind of rationalized on the R&D spends. Most of the platforms are in the market right now. So the incremental, cost of managing the platform is very little, right? So that's going to give us efficiency. And more importantly, the SG&A costs are all front-loaded, so any revenues will go into profitability. I think, this is the same point we mentioned earlier. So we are tracking, for, a turnaround both, from a profitability standpoint. Maybe by end of this quarter, we should be close to turnaround in the business, sir.
Thank you.
Thank you. We have a next question from the line of Aniket Dogra from Centrum Broking. Please go ahead.
Hello, Mr. Tyagarajan. Sir, just forgot to mention in the last question, when are we starting the buyback in HCPI?
So the buyback is already happening, Aniket. So I think I mentioned to Harish that, you will see the S1 later in the day, right? There we have clearly, I think we've done close to 60,000 shares that we bought back in the US. So the moment we announce, so there are certain restrictions on how much can we buy. We cannot buy, I think, more than 25% of the daily equity. We can't create the market for the day. So we are careful about, given the restrictions on how we buy back, we are managing that. But I think we have already bought close to 60,000 shares from the market.
So approximately, what is your average buying price at what rate approximately you have, bought the shares at? Is it less than $1?
So this is even less than that. I think it's sub 80 cents.
80 cents. All right.
In that range. Yeah.
Okay. So this is just a hypothetical question I want to ask you, but still holds some meaning because Mr. Ramani was the ex-CFO of the company, and so we are still paying back so much of his loan. So why not, is there a way to convince him and try to convert his debt into equity at the time when company needs so much capital, and so much capital can be used for the business? It will be kind of a win-win situation. Instead of taking interest from the company, being an ex-CFO, why can't he, or the management try to convince him to convert his debt into equity? There will be cost saving for the company, and there will be significant value addition for his equity also going forward.
No, I think, there is a restriction on conversion because at the time of taking the loan, it was meant to be repaid. It was not taken as a convertible loan. So we are informed that, from our legal experts that, we cannot do that restriction. There is a restriction on conversion to equity. I think more importantly, the cash has already come and we invested in the business. So our objective, as we stated above, if you look at it, last 4 quarters, we already repaid the 20 crores, 21 crores of Ramani's loan. So we will continue to keep repaying that. And, as I said, our objective was to, repay all the loans and just be, barring the working capital loans, there won't be any other loan in the balance sheet, Aniket, over the next 3 to 4 quarters.
Okay, that is okay. But, from time to time, we keep having this working capital loan also. So even if you exclude, 70 crores, so if you there will still be about 30 crore loan, right? Working capital, if you net on the net debt, if you exclude all these, Rummy loan also and everything. So what will be the kind of working capital loan if you exclude these promoter loans also from the company?
So at a gross level, it will be around 80 crores right now, but obviously there is cash in the balance sheet, which is about 50 crores. So the net debt will be around 30 crores if you exclude the promoter's loan.
Okay. All right. Okay, that's it from my side. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question from the line of Rajesh Shah, an individual investor. Please go ahead.
Mr. Tyagarajan, I have 3 questions for you. One is with respect to Devcool acquisition. Can you hear me?
Yes, Mr. Rajesh, go ahead, sir.
Yeah. So we raised money through the IPO process for HCTI, and in a matter of few weeks, we went for the Devcool acquisition. So don't you think we could have waited for some time and we could have used that cash much better way, for example, to clear off all the debts? Because as yet, we are not seeing any revenue accretion for the company from Devcool. So in a sense, we have wasted a lot of money that we raised through the IPO process also. And at the same time, we are reducing continuous cash flow from our company to again repay the debt. So it's like a loss-loss situation on both ends.
Okay, so your first statement is not completely right. So first, let me clarify. So I think we also mentioned this in the past, that we did an accounting change from a cloud hosting cost standpoint. So earlier in the last year, the revenues included approximately $3.5 to $4 million of cloud hosting, which came in at about 7-8% margin. So the cost also included that. So we kind of changed the reporting to include only the margins in the P&L. Right, Devcool, I think I explained earlier, from an acquisition standpoint, when we acquired the company, it was close to $20 million. We acquired it at a very decent price, and then, they were decently profitable. And more importantly, the strategic, because Devcool had access to some of the large Epic, clients, and, gave access to one of the biggest hospitals in the US, right? So from a strategy perspective, Devcool acquisition is actually the right strategy. And I just mentioned that, we are already in discussion with them for cross-selling some of our platforms, right? So from that perspective, there is no second thoughts that it was one of the decent acquisitions that we've done, and they in fact in the first year of operations they will do much better than what they committed to us at the time of signing the share purchase agreement. That's point number 1. Point number 2 is that it came at a fairly decent price. So the price that we paid was, and 60% of the money was paid upfront, and then 40% was linked to deferred payouts on performance, so they got to perform. So it kind of, works as a win-win for us that, they perform only then we pay the money. So as of now, they are in the year 1 of operations, they have done, and, they perhaps going to meet their numbers or marginally exceed their numbers. So that's one other thing. And as I said, as a strategy, it was a major acquisition because it gave us entry into an Epic space, which is Epic, for example, controls 2,600 hospitals across US, Mr. Rajesh. So that's got the biggest, from the EHR vendors, they are the biggest in terms of size. So we didn't have access to Epics, and now, we've got complete access to Epic. So, I mean, yes, it's a big partnership for us. It's going to take a year or 2 to see the full fruits of the acquisition, because right now in the P&L, what you're seeing is only Devcool related revenues. So once we start selling our, platforms to them, whilst the revenue goes up, the margins will go up significantly.
Okay. So secondly, my question was with respect to the transparency issue earlier also that was there with the company. The thing is, like you said, the chief revenue officer resigned currently. Okay. So it was not intimated to the BSE exchange or the NSE exchange also. So why that way, sir?
I don't think there is a requirement to, because he's employed by the subsidiary company, sir. There is no requirement to announce that to stock exchange. But having said that, I mentioned we are a performance-driven culture. We want to inculcate that across the organization. So, it was a clear case of performance issue, and we had to disengage with the resource immediately, sir.
The idea was, when we recruited him, we had initiated, informed the exchange that we are recruiting a person who was with ex-Infosys and all, and he used to manage a big account of $400 million, etc., etc. So since that same very person is exiting, don't you think it's a big deal for the company also, as well as for the shareholders?
Yeah. So,
We have
since there was a performance-based issue, Mr. Rajesh, we found it perhaps, right not to announce it, and maybe there's not requirement of LODR to make the announcement. So.
Okay. My third question is a really tough question for you, sir. I happened to read the SEBI report. And in that report, while I was reading, I went across that revenue were overstated by almost 85% and expenses were overstated by 95%. So how do shareholders can now feel the genuinity as to what the numbers are going on or the current workings of the company, due to which, all the, you can say the share price fell down, the cases went on, and the company, went into this all SEBI case, forensic report, etc., etc. So how do we as a shareholder feel the genuinity that currently the numbers, the expenses numbers, etc., etc., being stated are genuine?
Yeah, so I mentioned this earlier, sir. So since you mentioned the point of the interim order which has come from SEBI, I think it contains a lot of inaccurate assessments, sir. I mentioned it earlier as well, right? So it is premature to conclude anything based on the facts. We are seeking legal opinion. We will come back to you at the appropriate time with further details on this. I may not be able to divulge anything beyond this at this point in time, sir.
Okay. Okay, sir. Thank you. That's it from my side.
Well, it's 1 on the clock, sir. If there are no more questions, we want to wrap it up.
Yes, sir. As there are no further questions, I now hand over the conference to Mr. Vastupal Shah from Creaney Advisors. Over to you, sir.
Thank you everyone for joining the conference call of Securekloud Technologies Limited. If you have any queries, you can write us at vastupal@creaneadvisors.com. Once more, many thanks to management team and all the participants. Thank you.
Thank you. On behalf of Kirin Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.